In Australia, we often hear that our central bank, the Reserve Bank of Australia, is independent of the federal government. But in truth, central banks the world over have very limited independence. Whilst the idea is that the central bank is free to pursue an interest rate policy target independent of the government to achieve goals which we will explain shortly, the interest rate is defined by the Reserve Bank of Australia Board, who operate to meet an inflation target set by the government. It is important to note though that this entire RBA board is appointed by the government, including the governor and the deputy governor. While the top public servant in the Treasury, the Secretary to the Treasury, sits on this board, and the board operates within the legal framework set out by politicians under the Reserve Bank of Australia Act 1959. In accordance with this Act, the RBA is legally mandated to achieve three key goals. 1. The stability of the currency of Australia. 2. The maintenance of full employment in Australia. And 3. The economic prosperity and welfare of the people of Australia. When discussing central bank independence in 1994, then RBA Governor Bernie Fraser stated, "There has always been some kind of a relationship between central banks and governments. Given that central banks are created by government legislation and derive their powers from such legislation, they cannot be completely separate from the government." A mark of our current neoliberal period is the depoliticisation of decision-making from both sides of politics. That is, the distancing of politicians from unpopular decisions by deferring responsibility to unelected technocrats. When the Rudd Labor government was elected in 2007, incoming Treasurer Wayne Swan and then Governor of the RBA Glenn Stevens reaffirmed the RBA's independence in their updated Statement on the Conduct of Monetary Policy, which incorporated substantive amendments relating to respecting the independence of the Reserve Bank. Fundamentally though, this statement outlined ultimate power lies with the Governor and the Secretary to the Treasury, and despite this statement being revised in 2010 and 2013, it remains essentially the same to this day. So if the Treasury wanted to raise interest rates, which could be politically unpopular because of its flow-on effects to the wider economy, where borrowing becomes less appealing with interest rates rising, the RBA would be said to be the key decision maker. In this illusion of central bank independence, the Treasurer, and therefore the government, has the ability to defer responsibility to the Governor of the RBA, who will announce the interest rate target agreed upon by the government, but at the same time enable the government to appear impartial in this target. Should there ever be a policy disagreement between the RBA and the government, there is a process that allows the government to override the RBA's authority and compel the RBA to comply with the government's desires. Despite the prevailing myth that the government and its central bank are entirely distinct entities, we can see that this independence is merely a facade designed to obfuscate who is really making the decisions. As John Maynard Keynes's contemporary Joan once said, "The purpose of studying economics is not to acquire a set of ready-made answers to economic questions, but to learn how to avoid being deceived by economists." Comment to join the conversation or subscribe for more videos.